Morning, everybody. How are we doing? Morning, Danny. How are we doing? Happy Wednesday. Member stream time. So today we're going to go through the usual stuff. Going to look at the opening range breakout. See how we get on with that this morning. Great day yesterday. Made a grand yesterday. Made up for Monday's loss, which is about 400-ish. So up 600 on the week. Going to look through FX pairs. I've taken a few new positions on yesterday. So I've got pretty much full exposure that I want on at the minute in both directions on most stuff. So we'll have a look at what's going on with FX. We'll have a look at the CPI from yesterday as well, because obviously we have some CPI news. Morning, Peter. Morning, Lucas. And then we're going to go through this morning. One of the members, I think it's a member anyway, not sure. But someone that's asked me to have a look at the pre-market ranges with the ORBEA. So looking at obviously the breakouts, the original version of the opening range breakout strategy, we had a pre-market on it. And it is a good strategy, but it is a little hit and miss sometimes. So it's just basically taking the pre-market range break, obviously, before the market opens, in which case it's here on that and here on that. So it's getting that initial 5-minute candle profit, which can some days be the start of the entire day's move. If that 5-minute breakout is going to go long today and it's not going to stop, you got a potential for sort of 15, 20R trades often. But the danger is obviously the open is very whippy. So we quite often will get stopped out on it regularly. So it's just seeing if there's a way to trade that pre-market range with the ORB version 3. Also going to have a quick look at the 15-minute range break, the second 15-minute range break, which is one of Tom Hugard's strategies, if you're familiar with him. I've never traded it. I did some testing on it, excuse me, a while ago. And I couldn't find an edge in it. But I didn't use any kind of distance measurement or volatility measurement when I did that testing. So I thought I'd revisit it. Again, because someone was asking me for the settings to trade his strategies, because obviously the ORBEA, his strategies are quite similar. Well, they're pretty much open. They're breakout. A lot of them are breakout open strategies. So you can trade most of what he does with this as well, but obviously everything is discretionary. So I thought we'd look at it. Long on the FTSE. So quick long entry there on the FTSE. Ranges are in on the DAX as well. So not pre-market, 5-minute ranges today are tradable. Very big spread today on the FTSE. Quite sure why we got such a big spread there this morning, but we have. It's pulling back now at the moment, so that might be a stop out this morning. But anyway, we'll see what goes on with that this morning. So that's the plan anyway. Right, so there's your 5-minute ranges in. News-wise today, we've got wage price index this morning. It was already come for the Australian dollar. Doesn't tend to do a lot. We'll have a look at that in a second. But that's it for today, so there's no other news. Yesterday's main news was obviously the CPI numbers. So everything came out negative for the US yesterday. Year on year, inflation dropped. Month on month, inflation dropped on the forecast, which is increasing basically on the previous. And the core CPI dropped on forecast, but that is increasing on previous as well. So overall for the year, inflation has come down in America. They were forecasting it to stay the same, so it's slightly lower than forecast. But the rest of these, although they are lower than the forecast, they are still up. So the result of that is fairly mixed. If we look at what happened to the US dollar yesterday, Euro US, you can see basically we had a bit of weakness coming into the US, as you would imagine. They're negative numbers, so therefore it's negative US because it's more indicative of being able to drop interest rates, which weakens currency. So that's the right move. But the actual amount of movement, as you can see, was very, very little. So we moved 83 pips. ADR is 103. So it didn't even push an ADR. Considering this is the second most important news event of the month, it hasn't impacted the market because obviously at the minute we know it's all about these tariffs. So I don't think at the moment the market really has any faith in any numbers in fundamentals because they're going to change with what's going on with these tariffs. So looking at these are indicators basically. So they're the same as indicators on your chart. If you look at a moving average that goes like that, it tells you that the price of the candlesticks has been going up. You can see that by the price of the candlesticks. If you look at CPI data, that's come down. We know it's come down. Yeah. But what is going to happen in the future has got nothing to do with historical. And at the moment, these figures are telling you what's happened in the previous month before all the tariff chaos started. So they're just not relevant at the moment. They will become more relevant now the tariffs seem to have reset themselves. So I think we're probably going to enter back into a more of a state of normality now, as long as he doesn't change anything to do with the tariffs, obviously, which, you know, we just do not know. So I don't think that's going to make an awful lot of difference to directional bias for the dollar moving forward. We've got no more news today. Tomorrow we've got unemployment for the Aussie in the morning. So we'll have a look at that. Overnight, nothing much particularly exciting has happened. Trump said an awful lot of stuff. He was obviously over in, I think was it Qatar? Or wherever he was. He was in the Middle East somewhere doing deals and all that sort of stuff. So some massive numbers being thrown around yesterday. Morning, Leon. So yeah, we'll see what happens with that. But we've got nothing else particularly exciting happening overnight on the news. There we go. It's Trump and his Saudi Arabia dinner. So that's basically where we are at the moment news-wise. So there's nothing else to report really today. Yesterday, we had a fair bit of movement, but no real direction yesterday. So I didn't manage to bank anything yesterday because nothing really moved. This morning, we've got no ADR hits. We've already got a weekly on the Aussie CAD. So Australian dollar CAD, basically, I mean, that move yesterday. Oh, yeah, that was a big one yesterday, wasn't it? Excuse me. Yeah, we did have some movement yesterday, didn't we, on the Australasian pairs. So Aussie dollar CAD weekly range put in basically in 24 hours there. There's a little bit of an extra candle on there, which was the overnight spread, but lovely mean reversion opportunity on that one. Aussie New Zealand, I'm already short. That kind of stalled out back up at the previous day's high and pulled back down today. So it does look like it's trying to rally again. Australian dollar getting some decent movement in. Aussie US, I took a short on yesterday. So this was I think we got 150 ADR on that yesterday, and it's an RSI extension on the hourly. If you look at it long term, we are sort of back up towards the highs of the range. We're not really going anywhere. We've got this wacky great propulsion gap down here. That CPI number caused, well, it was already moving when the CPI came out, which caused the additional movement. And I don't believe that CPI number is going to weaken the dollar. So I'm still expecting some kind of downward movement on this and a reversal to come in, but we'll see what happens. Swiss yen, I got in a short on again yesterday. So we're back up. This was the one from 2 days ago, 3 days ago now. Back here. So I'm still in this short, not really gone anywhere. Euro Swiss didn't get into yesterday. I was toying with getting into a short on that here yesterday. I didn't take it. Should have done. But yeah, it's not really going anywhere at the moment. Didn't quite get extended. If that was extended on the hourly, I probably would have jumped in that, but I didn't. Euro pound today I will be taking another long on the euro pound if we get a drop down here. So lovely big strong move down on euro pound. So looking for a push out of propulsion now. I was looking for a bounce off of here. We didn't get it. So now I'm looking for a bounce out of propulsion. If not, I'll be looking for a bounce out the previous monthly. So I've only got 2 positions on it. Third one will be going in on that one today. And then I'll be looking for a pullback on that leg there. So where we've moved down, kind of from here, really. I'll be looking for some kind of pullback on that for an exit. Euro CAD, that's one I took yesterday, I think. Yeah, so I took a short on the Euro CAD yesterday. So we've basically broken out of the range. So there's your range low, your weekly low. We slammed through that yesterday, straight into propulsion. They bounced out of it, market reversed up. I'm looking for a sell back out of this propulsion gap for a short play. So obviously we are rolling over now. Market structure is bearish. So I'm looking to short that propulsion gap down into the lows. It's not an RSI extension play. It's just a short out of propulsion. So that was an ADR hit to the upside. After that, huge propulsion move down. So I'm selling this propulsion gap basically. Looking for a lower low basically. And the pound US dollar. So this, I've got a couple of sells on. Second entry was taken yesterday. First one was taken on Monday. So I took this one in the live room on Monday when this obviously all happened with the news, expecting some continuation strength on the US dollar. We didn't get it, did we? Now the CPI pushed back up. Took second entry on that one yesterday. So the average is really nice and close. We are starting to see strength come into the US dollar. Obviously, starting to see strength coming into the stock market. I'm expecting a rollover back down, at least into propulsion, to undo half of that move. So I'm happy short on this at the moment. There's no reason for this to be bullish, the pound. There is reason potentially for the dollar to be slightly bullish, but I don't think it's going to be as strong as it used to be, because obviously the world is now really not interested in the dollar because he's basically stabbed everyone in the back. So economics is too big for us to suddenly go, sorry, we're not going to deal with the US anymore. We've still got to deal with the US. There's a lot of trade agreements. There's a lot of businesses that rely on import-export. We can't just stop doing it, but gradually we will change it. It's exactly the same as what the Europeans have done with Ukraine. So Russia invades Ukraine, oil prices go through the roof because all the oil pipelines go through there. So we can't just suddenly go, don't worry, we won't use oil. We still have to get that oil. However, we are now changing all of the relationships. We are now going over to more sustainable energy. We're getting oil from other places, so we're not reliant on just one oil pipeline. Same thing. We are not going to be reliant on trading with the US. We will do a lot more deals elsewhere now. So the dollar isn't going to have the strength it used to. It's just not going to happen overnight. It's going to take time. So, but equally, it is still the dollar. It's still going to be strong. So we're just waiting for some more good news to come out. Trump has done all the bad news for the dollar. I think he's got it all out of the way now. So he should hopefully be able to continuously concentrate on all the positives, hopefully, that this trade war is meant to be producing. So I think we probably will get some strength in now. So obviously you can see the market structure has shifted definitely on this. So I'm looking for pushes down into lower lows. So that's what I've got on at the moment. There's a couple of other weeklies which you can get into as well. Aussie US, obviously that's the one I've just got into. It's weekly extended, so I'm looking to short. I'm already short. Euro US dollar, also same thing. That's pretty much the same as the pound US dollar, but that's your extension to the downside. It's already played out, the weekly. The weekly was down here because it did it all pretty much in a day. And you've got New Zealand dollar CAD as well. That's the other extension to the upside. And again, it's all the Australian, New Zealand moves. So this is basically the same as New Zealand dollar, US dollar. Lovely short opportunity, M pattern formation. There's no reversal alert on the hourly because it's too far away, but that's a lovely resistance there for a short look. So it's either going to bounce here, which it has yesterday, or we're going to come up and retest this propulsion move, which we triple topped at. If we retest that, you're definitely going to find some sellers up there. You've got another monthly high look just above that one. And again, it's the same thing. I'm expecting some Canadian strength with the dollar to come down. the trouble is the commodity markets are doing pretty well at the moment, which is New Zealand, Australia, and Canada. So difficult, but that's a nice short. Just about got an RSI extension on that one. 4 hour, not there. So yeah, could go either way though. These, the moment is this market is confused.com. So right, RSI extensions. There's nothing to look at. Aussie dollar Swiss is your 4. That's all we got really. Aussie Swiss and Euro odd. So it's not quite a divergence on it, but it's fairly bearish. You've got this gap fill to fill here as well. So there's a good 175 ADR to the downside on that. Euro odd. That's a nice extension to the downside as well. So this is the range that we're in for 4 weeks before the bond purchases came with the realization we've got to pay for our own defense in Europe. That is now back to the origin of the move. So this propulsion gap, obviously we got the bounce and it slammed through it. So target on this is going to be these lows. So previous 2-month low, which is 100 ADR today. You are extended on that now where we are. And obviously you're half an ADR away from that monthly low. So not a bad place to be starting a position, already extended. It's very, very grindy though. Yeah, so that's where I think we'll probably get a decent bounce out, but how far it will be, we'll have to wait and see. But that's getting pretty good for a long opportunity as well. So there we go. Let's have a quick look at the indices. So FTSE long break is on. No trades on the DAX yet. DAX yesterday. Morning, Chris. Morning, Mark. My God. What a hideous beast. Look at it. So that's the open. You can see where the opening range trades were trying to be taken. So we had this big old 5-minute candle going. And then we sat inside that for about an hour, triggered a short, which immediately sat around for another hour and a half and did nothing. Finally, after about 2 or 3 hours, we moved up. Yeah, 2 or 3 hours of going nowhere to then sit around and do absolutely nothing for the rest of the day until the New York Open, when it triggered a long. And then it sat around for the entire New York session and got me out with that much profit. I've never seen anything like it. The DAX, it's almost as if, I don't know, there was absolutely no interest in buying or selling yesterday. I was watching this thing I kept tuning into it kind of every half an hour, like, must have gone somewhere by now. Unbelievable. So, yeah, absolutely nothing you could do with that yesterday. Awful. Absolutely awful. And pretty much the same on the FTSE. It was a similar sort of situation yesterday on the FTSE. I took... why are you not... Odd? Oh, yeah, that was yesterday, yeah. So FTSE yesterday got a long break and sat around in the long break all day. Yeah. And then we came down in the New York session, which was there, and then finally stopped me out on that trade. But it's just diabolical. But all the European, I don't know why, but for some reason, I mean, obviously we know why, it's CPI. And obviously CPI day, you tend to get not a lot of movement, but that's like the worst I've seen. But anyway, but lovely trades on the NASDAQ yesterday. So NASDAQ clean break and yeah, absolutely huge profits on the NAS yesterday, which is lovely. FTSE was, S&P was the same. I took that one off early there. Just because the NAS and the S&P are moving the same. No trades on the Dow yesterday. Dow ranges were just not right. And it's quite good because obviously it didn't go anywhere. So, but overall, good day yesterday. So we'll see where we go today. Where's my FTSE gone? There we go. So long on the FTSE, no trade on the DAX at the moment. Anybody got any pairs specifically they want to look at? Any positions they're in they want to discuss? That's what I've got on at the moment. So my exposure at the minute is I'm short Australian dollar. I am hedged. Sorry, no, I'm short long on the CAD. Swiss franc short. Euro, I am hedged. So I've got positions in both directions on the euro. Pound, I've got shorts on. Yen, I've got long. New Zealand, I've got long. And US dollar, I've got long. So that's basically my current exposure. So hedged on the euro, but everything else is kind of, I mean, everything's just kind of flip-flopping around a little bit at the moment. So I'm just going to adjust that. Recent orders. Eight. Crashing. Yeah, so that's what I've got on at the moment. I haven't really had anything that I could bank. Australian dollar's the only thing that's really getting away at the moment, which I've got 3 on, but I mean, it's only 3, so I'm not that worried about it at the moment. I get the feeling on this we're going to put a deep pullback on this leg, possibly even a double top with last month. We're just going to V-shape recovery this, so I might need another couple on this one. And if that happens, obviously, we'll be looking for a pullback on that entire leg. So that's the only thing I've really got. It's not in any way, shape or form in any problem at the minute, but it's just grinding. It's one of those grindy pairs. Always is. I didn't like trading the Aussie New Zealand for a long time. I've got into some horrible squeezes on the Aussie New Zealand. I've got really low exposure on at the moment, really low risk because of what's going on with the market. So I'm not really bothered about it. It can go sort of 5 or 6 ADR as far as I'm concerned. I don't really care. It will come back. It's just, it's one of those pairs that when it gets into a rhythm, it just grinds away. You don't find very many propulsion gaps on it because it doesn't make those big moves because they move together. They're both commodity pairs. They're both Australasian pairs. They both trade in the Asian session and they both move together. So they grind a lot. But when you get one of them taking advantage because of interest rates or inflation, that's when you get those parabolic moves. And then you tend to get it sort of starting to go into a more normal market structure. But the minute it's just a grindy mess. So I've already taken some profit out of it, but just one of those pains at the moment. Maybe we can have a look at oil. We can have a look at oil at the minute. I was looking for, and I think a lot of people were looking for $50 a barrel. Doesn't seem to want to do that, does it? So we are just stuck in a very large, wide range at the moment. We got this gap up here, which we've not got back to. It's unusual to find a gap, but obviously this one caused by Mr. Trump. So, you know, these sorts of fundamental gaps, quite possibly you won't get back to them for a while. But last couple of weeks, we're obviously bullish. You've got resistance coming up. We are at resistance right now, actually. The 2-week high is holding. Your 3-week high is there, which is this propulsion move, which wasn't really... Yeah, I suppose it was actually. So it's this double bottom break, that propulsion gap. So that is a very strong move. But this is all part of the Trump tariffs and the undoing of the tariffs. So again, you know, is there going to be the same interest in selling here today than there was back there? No, because this is all part of a panic sell, isn't it? This is that 4% fear that we got down to on the fear and greed meter. This area here obviously is where we bounced. So there were legitimately sellers in this area, assuming that the tariffs were going to still carry on going wrong. Yesterday or on Monday, he's undone the China tariffs. So there's every possibility, anything that hasn't already corrected the entire Trump move will attempt to correct the move. So you got two ways to look at it. either you think we're going to get back to the origin of the move, and I haven't been paying much attention, to be honest, to what they've been saying about oil production levels. But we could well just grind back up to that. So I would be more interested in shorting from there. You've got some nice divergence at the moment, which is bearish at the weekly highs. So, we've made a new high, but on less relative strength. So there's potential for this to sort of come down from there and just sort of flip-flop around in here. But whenever I see a gap, you're always looking for that gap to get filled. That's 2 to 3 weeks potentially to get back there. It came down obviously in like a week because of the it's the biggest move we've had in the markets pretty much ever. Yeah, excluding COVID, markets never moved like this before. It's a complete anomaly. It's impossible to tell how long it's going to get back to it. But if you look at how long this has taken, that's a couple of weeks. That's a couple of weeks. Looking at somewhere between 2 to 3 weeks as a long. If you're shorting it, though, you're probably going to find you're going to bounce out of highs by, for a couple of days downward, and then you're going to flip back up. So it depends how it gets there, doesn't it? Now Trump's undone the China tariffs for 90 days. And obviously the European tariffs and everything else is all frozen for 90 days already from here. I think the market is just going to return to normal. So the directional bias on oil should be supply-demand driven as normal. So it's just a case of keeping an eye on what's happening with supply and demand. But the market structure on it is, you can't tell what it's going to do at the minute. It's up at the highs. I'd rather be shorting it than longing it. But my heart is telling me we're probably going to do that gap fill at some point. Yeah, gaps get filled, but gaps when you have trade tariffs that we've never experienced in the world before, no one can tell you where it's going, can they? Is it going to get filled? Is oil demand going to increase or drop? This is partly why I don't trade oil, because it's manipulated by the Saudis the majority of the time. So OPEC decide on oil production levels and caps. And the Saudis obviously have more money than God, and they will basically do what they like with it. So they will tell OPEC, we're going to produce more. And OPEC will go, we want production kept at this level. And then we'll go, well, we don't want to do that. What are you going to do about it? And what happens is basically everybody does what the Saudis want. So if they constrict supply, cost of oil goes up. If they produce more, cost goes down. That's the way it works. Trump and Canada want a steady price between $60 to $65 a barrel. This is a healthy, sustainable business level for oil. So if you go back historically, this is a bit skewed now because obviously what happened with Ukraine, but historically you won't find pricing going, got to go back quite a long way, haven't you, now to find the lows. Tell on this chart. But historically, you'll be looking at somewhere around where we are for the lows most of the time for modern day oil production, because it's not cost effective to produce it below that level, which is where they start to constrict supply. And as they do that, because the demand stays the same, the supply drops, it becomes a more valuable commodity and the price goes back up again. So this makes sense to be a low, but it's a low that's been caused artificially. So, this is not my area, oil. It's a real fundamental. Anything that is in the commodity markets is fundamental driven and supply demand driven. You really need to know a lot about what's happening in the industry with supply demand and that sort of thing. So fundamentally, it works with market structure and trends as normal. But it will go out of trend, just like that, and catch you out, which is why I don't position trade it, because I've found it very profitable most of the time. But when it's not, it really goes parabolic. You know, it suddenly starts going into crazy runs, which don't recover. There aren't any actually recently that you can see on the chart. In fact, you know, recently it's been very, very good. But I mean, that's 2 weeks worth of dropping. But it's more the speed of the drop. It's like gold. It's the same as gold, which is why I don't trade gold. It's not so much the way it moves. It's the speed it moves at. Yeah, so these big moves down. There's another gap, look. Pretty similar to what we had here. So you can see the market tried to rally back up. It made another gap there. That gap got filled. That gap took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 weeks, 3 months to do that. We are 1, 2, 3, 4, 5, 6 in. So look at it being potentially another month and a half before we get back up to that gap fill, if we're going to just do this sort of movement. But, you know, when it takes off for a reason. There'll be something that triggers a move on it. And it's the same with oil, gold. There'll be something that triggers a move on it. And what happens is you get a parabolic move which catches you offside. You suddenly find yourself jumped into 2 or 3 positions, and then it takes off. It's very difficult to survive it because of you're already in a few positions, like here. You got into a few positions there, and then it went. You were already really extended. So it's one of those instruments that just catches you off guard when you're position trading. So that's why I don't do it. But yeah. Market structure wise, though, higher low and a lower high, which is a contraction. So contracting for a break, that's the most logical way to go, isn't it? But right now it's a short because of the highs we're at. That probably doesn't help you at all, does it? But that's my take on it, because I just don't really get involved with it much. One of my nemesises. Right. Back down to the open on the FTSE, or opening high. Short on the DAX. So I've got a hedge on today. So long FTSE, short DAX. One of them, if we get a trend day, is going to fail. See what happens with that. We'll come back to it in a minute. Right. Okay. So that's all I wanted to cover this morning from an FX perspective. I'm not going to go through all the pairs at the minute. We've got no news today. So I suspect today we'll probably go sideways, or we'll probably start undoing a few of those little moves that we had. We've got some gaps here to be aware of as well. But there's a few things that have gapped, especially the end pairs, really. At the moment, so there's a lot of opportunities for mean reversion this week, where we are kind of at the moment. So just bear that in mind when you're looking at positions and entering new positions. Right, so testing. So opening range breakout. Wanted to look at the pre-market ranges, and obviously I'm also going to quickly test the second 15-minute range, which is one of Tom's strategies. So with the pre-market, all we're looking at really with pre-market range breaks is the 5 minutes before the open, which is or whatever period before the open. So let me just draw a line at the open. There. So all a pre-market range break is we're looking at what's happened before the market opened. With the DAX, we get roughly an hour. With all the US indices, we get the entire session, because they have the Globex session, which is the electronic pre-market trading. So what we're looking at is what's been happening recently at the open, and can we find a decent size of range that's not going to be too tight, so that we're going to get whipsawed at the open, but not too big, if there's a lot of pre-market range at the open, we're probably going to get not a lot of volume at the open, because it means that something's happened pre-market. But that's all it is really looking at is we're seeing if there is a kind of Goldilocks zone that appears more often than not beforehand, a distance or a size that will allow us to get a regular risk reward out of that initial 5-minute candle. So we're looking for that candle there to try and give us a reward, which is more than whatever we're going to risk. But the risk ideally won't get stopped out. And this is where the danger comes with this pre-market. This is a little bit, when I've traded this and when I've done all my analysis and testing on this in the past, I've always found it to be a little bit like a trend strategy. The strike rate on the pre-market break is very low because the market at the open is dumping orders, which tends to not be directional. They have a fixed amount of orders they need to execute for customer orders, etc., at the open, and all the banks and institutions are just getting rid of those orders because they're not price sensitive. We just want them filled. Anybody give me a price on X? Yes, okay, I'll have it. I don't care what it is because it's within the range that the customer's supplied. So that you get this massive movement at the open where there's a lot of big volume comes in, and you go like this quite a bit, and then all of a sudden there'll be a bias where there won't be orders to fulfill and the market will have to take off and find new prices. And that's where you get your opening range candle. Yeah, so it's the initial cash balance, as they call it, that goes in. If at the open there is an imbalance, you will get a large movement in one direction or the other. And that is what we're going to take advantage of, basically. So this first 5-minute candle before the open, most of the time I find tends to be the bigger candle, because obviously you do get a little bit of order creep coming in before the open. It's a little bit like a race where you've got a start line and you've got cars lining up at the start line, and you know, this one moves forward a little, this one moves forward a little bit, and there'll be someone that will just go a little bit further forward to the line and try and jump the start. You get more volume coming in on this 5 minutes. So this is the candle that most of the time is going to be measuring the range. If it's a tiny little candle, though, we can look at whatever range we want to before that. So we can look at the 30-minute range, a 15-minute range. We can do whatever we want with it. So it's a case of trying to just measuring this and trying different variations to see if there's an edge there. So I've set the EA up basically on the DAX at the moment. So at 10 o'clock, which is the open, 8 a.m., it's going to look at the 1-bar range, the 2-bar range, and the 3-bar range. I'm going to ignore the 6-bar range for the moment. I'm just going to look at that 15 minutes beforehand. And I'm doing this on the 5-minute chart. But you could do this on a 15-minute chart and look at the 15-minute prior, the 30-minute prior, and the 45-minute prior. So this would basically take into account, if you did it on the 15-minute time frame, it would take into account pretty much the entire pre-market range on the DAX. So that's your first 15 minutes, your second 15 minutes, and then your third 15 minutes. So you're always, I think, if you use a 15-minute time frame to attempt this, you're always going to find a trade, because that 45 minutes before the market, you're always going to find something that is over X% of ADR, because by its nature, this pre-market movement will, quite often includes that close of the previous day. So it's broker candles showing you where we've gone from yesterday's close to today. That's going to be more than 10%, 15% of ADR. So it's an option to try it on the 15, but I think initially I want to try it on the 5 and see where we go. Closing out end of session, I think we'll probably stop out or hit target before then. So I'm using ADR 10 as standard, not taking into account what's going on with Trump at the minute. Minimum range I've set at 10% of ADR, because obviously we are pre-market. There's not a huge volume, therefore you shouldn't be putting in huge ranges, I don't think. So 10% is kind of the minimum I think you want to use, but we'll test this, because if it's less than 10%, i.e. 5% of ADR, when that candle opens, the volume of orders coming in is probably just going to stop you out both ends straight away. Yeah. So I don't think anything less than 10% is worth testing. 10, 15, 20 probably are the ones to look at, but I don't think you're going to find them very often. So we'll just test this and see what happens initially, and then we can obviously develop it from there. I've put a loss recovery system in place, just standard, just to see what happens. But stops at I've set as a multiple of ADR at 10. So we're going to use a stop, which is roughly the size of the range, at least, that we're going to measure. ADR a target, which is normal. I've put partial profits on. Shall I use a trailing stop? I'm not going to use a trailing stop on it. So target, I've set as a multiple of ADR at the moment at 0.5. I think we'll go with a 0.3 on that. So we're looking for a 3R return to take 75% of the order off. So that's kind of an initial setting, which I think is probably going to be a good starting point to go from. I'm just going to run it on, actually, I'll run it on tick, actually. And we'll watch it visually to start with, just to see where we go and make sure it's working properly, first of all. So the first part of testing is visual testing to make sure that it's doing what you're expecting it to do. Obviously, with EAs and with strategies, it may suddenly go, it doesn't do that. We're doing this the wrong way. So we're just visually testing to make sure it's doing what I want it to do. So there's the open at 10 a.m. That candlestick there. So we've looked at the previous 5, 10, and 15 minutes. So bar 1, bar 2, bar 3, pre-market. The 3-bar range is okay, which is that high to that high, that low. So the minimum we need is 221, which is 10% of ADR. And that range there is 245. So as I suspected, that 5-minute candle there was way too small. It's like less than 5% of the average daily range. So it's too small. We can't take a break of that, because look what would have happened. You would immediately just stopped out on both and you're done. That's it. The 10-minute range, again, slightly too small, 245. So is the 3-bar range, which is 15 minutes. So that's over the minimum. So I think that's probably kind of going to be the Goldilocks zone for this, but we will test different variations of it. So in this case, on this day, it tried to break long, triggered the order, immediately stopped out at the shorts, and we haven't managed. That's interesting. So we stopped out, but we haven't triggered the short yet. So we'll see what happens when we trigger the short, if we trigger the short. Okay, so short has triggered, straight back up, stopped out, and then it broke down. So in this case, if you'd have used a 6-bar range, would it have triggered? No, it wouldn't have. So in this case, we're going back into normal ORB strategy, aren't we? And we'd have taken a break of that short. So that would have been the best one to do on that day. But yeah, so there we go. So that one didn't work out on that day. Let's just check other days. Okay, so you got 2 dojis, deadstone dojis there, which aren't drawn because I've got my chart set up. I'll have to set line graph to black. There we go. So you got 2 deadstone dojis in there. Look. So the 15-minute range before the open, which is there, was 149. 10% of ADR is 196. No trade. So didn't take that. And look at that candle. So there's your 5-minute range gone in. Immediately blew the bottom, blew the top, and then sat around for 15 minutes. And this is why the opening range breakout strategy works. We're waiting for this choppiness to go, and then we start to trade. So the short didn't play out. The long did play out, but it didn't go until later on in the day. That's a news event at 1 o'clock. So that'd be US news coming in. So there's no trade there. That's good. So that stopped us from getting into trouble. Again, no trade there. Range was too small pre-market. Didn't get us into trouble. So we'd have taken a break long on that. You would have probably got 1 and a bit R out of it, but then it reversed down, stopped you out, come back the other way. So again, did the right thing there. Range too small, didn't take it. Okay, so this is a good example of some higher volatility. So you can see this 15-minute range, compare that to the last 2 days, much bigger. So we've done more than 10% of the average daily range in the run up to the market open. Market then has opened, pulled back, and is breaking long. So we're taking that first 5 minute. What have I got the target set at? 3R. 600 odd. Yeah. Okay. So there's target 1, 3R. So we've easily made 1R, 2R, 3R. So easily got a 1R or a 2R return out of that. So if that's something we need to test, what is the best time to take your targets off? Should we be leaving it? Right. So there you go. Easy 3R. Now we've got an ADR target to the upside. That's probably not a good idea because we're not using a trailing stop. So we might need to just trailing stop. So that day, that's annoying, isn't it? Stopped out. So we do need some kind of trailing stop mechanism to protect that second part of the risk. If we're going to use a partial, which again is something we need to test. So there's the second, the next day, 15-minute break to the downside, instant stop out, flip long on the 15, pre-market. That one doesn't look like it's going to work. Yeah. Market was coming down pre-market. The short failed. A breakup looks to me like a pullback, so that wouldn't have expected that to work. But anyway, would have worked if it hadn't stopped out. So maybe we need to be testing slightly wider ranges as well. But anyway, so it's working. So at least we know it's working. We're testing that 3-bar range. It's not taken a 1-bar or a 2-bar range at all, has it? So it's always working on the 3-bar range. Yeah. So you're never going to get a 1 or a 2 because they're going to be just too small and too tight. Always going to be less than 10%. Okay. So we're in profit. That's good. But we need to test some variations. So what we'll do, this is working on every tick at the moment. I've got this set to work on 5 months initially. I might reduce that a little bit. So going to test minimum range from, I don't think there's any point in going below 0.1. Otherwise, we're going to get too whipped out. We will test a 0.15. And we'll test up to 0.2. I doubt we'll ever get a 0.2 on. That's fine. Close end of session is fine. Yeah. Loss recovery, might as well carry on using that. That's fine. It's quite aggressive, but yeah. It's an aggressive strategy because we're using pre-market. So, right. So stop loss. We will test 0.1, which is 10%, which is the minimum range that we're looking at. If we test anything above 0.1, we run the risk of hedging. Because what will happen is it will take the short before it takes the long. But it might be an idea to test that. So let's go 0.1, and then I'll test 0.5 up to 0.15. So that's going to be just outside of the average daily range. Hang on. Just set that up wrong. I just realized. 0.05. So that's your stop. Take profits. So I'm going to leave the take profit at 1 ADR. So that is our runner, basically. I am going to carry on using a partial. We'll try that with a 0.0. Let's try a 1-to-1 up to 1-to-5 for the initial take profit. Because if we've got tight ranges, we're looking for, if we're using 10% of the average daily range as a minimum, yeah, what we're looking for is we want a 10% movement up to a 50% movement of the average daily range on that pre-market break. So when we go, we're saying, I want you to move half an ADR. at the open. Yeah, so that's quite a distance for it to move. Obviously, average daily range gets hit. That's where our main TP is. But I'm looking initially for, on that initial break, should we take a portion off at 1, 2, 3, 4, or 5R? Right, trailing stops. 10% of the average daily range is a trailing stop. So if we're targeting 10 to 50%, somewhere the trailing stop, I think 10% is probably right. So what I'm going to do is just say yes or no to trailing stop. So we're just going to do a test saying, is it best to trail or not? And the trailing stop I'm going to use initially, and this can be back tested and optimized and robustness tested on stage 2, is should we use a 10% or a 15% or a 20% trailing stop? So should we kick in straight away, or should we kick in after a certain distance has been achieved? So that's a test we can sort of fine tune later. But initially I want to know, is it best to use a trailer or not? I suspect it probably is. So we've got quite a few variations there. What I'm going to do initially is stick it on control points, just so that I can test test a large amount of data quickly, just to get a rough idea on what is good, what is bad. It's not going to be accurate, the results, but I can then use that to formulate a plan for testing at tick level. So this is just testing over 5 months. So we'll see how quickly this runs and see how quick we get these coming in results. This is going to run quite a lot of variations here. 60, that's not too bad. Okay, so we've got 60 variations we're testing here. That's around about 2.5 minutes, which is all right. So looking at profitability, return on drawdown, we've got a couple of results coming in which are good. A lot of bad ones as well. So this initial test is giving me an idea of, is it viable? Is it worth bothering with? So I'm just looking for, is it generating profit more than it's not generating profit? If not, then it's probably not going to be robust moving forward. Then we can look at different variations of it. So there's a few profitable ones coming in here. This is running on a 3K account, I think. Yeah, so it's a 3K account risking 1%. So we've got 1.37, that's pretty good. This is over 5 months, so it's generated $400 over 5 months, which is about 20%. No, it's not. Too early in the morning, brain fog. 600 would be 20%. We are getting some results in there that are generating decent profit, but 50% drawdown, that's not terrible. So drawdown wise, roughly 10% drawdown on all the results so far. So it's not looking particularly amazing, is it? So minimum range multiple 0.15. So we're looking for 15% of ADR seems to be the top results. This again backs up my other testing, which is you're better off using a 20% range. Stop loss at 0.1. 3 of 60. So we're flying through the results pretty quick. Nothing really exciting there. So looking at these results, you probably can't see them, but that is the last profitable result. Everything from there downwards is negative, doesn't make money. Yeah. So to me, it's not looking particularly hopeful that that is a good strategy at all. So 55 of the results out of 60 done. Nothing particularly exciting there at all, is there? Okay, so 1.37 is the highest profit factor we've got on that. you're taking roughly $500 a drawdown in 5 months to make roughly $400. So minimum range multiplier of 0.15. So 15% of ADR as a minimum on that pre-market range. Stop loss at 10%. So stop loss within the 15-minute range. Part closing either at 10, 20, 30, 40, or 50. Using no trailing stop. So that is the best thing to do, is not use a trailing stop. And it doesn't matter what you target, you make the same amount of money on 29 trades. So just run that quickly. See what that looks like. So not hitting ranges. There's a lot of days it doesn't take a trade look. This is the problem, because you don't get that pre-market range. Stopping out. We're making a lot of money. Obviously some news coming there. Oh, that's the New York Open. So we've got some news coming, or rather the New York Open coming there, which has popped it up. But that's fairly decent profit you got there, and it just gave the whole lot away for a loss, because there's no trailing stop involved. But if you use a trailing stop, it doesn't work, does it, as a strategy? So not really much use there. Yeah, a lot of times it's not taking a trade. So decent trade there. But the problem with the strategy is the initial range is too tight. So we're not getting enough trades on in 5 months to get any data there. So 30 trades in 5 months is not enough. We're missing far too much. So out of 5 months, we're missing roughly 70% of trading opportunities. So minimum range needs to be really, to get a decent pool of data, reduced. So we need to start looking at 5% of ADR, and then go up to, as 20% is really all that it's given us, we need to be looking at, say, maybe 15% there. So let's look at 5%, 10%, and 15% of ADR, which is going to be very, very tight. And let's look at changing the partial close targets. So if we're going to reduce down, we'll start at 0.1, which is 2R. We'll go up in 0.5 increments, and we'll go up to 0.25, which is then potentially going to become 5R. Yeah. So we're testing 2R upwards, basically. There's no point in running it at 1R, because you're just going to get, if you get stopped out 2 days in a row and you get a 1R return, you're going to reduce. You're going to need a massive run of continuous wins to make money. This is a breakout strategy. Strike rate's always going to be low. So you've got to use at least a positive R on it. Trailing stop, we'll test that on and off. Now, the trailing stop, if we get to, if we're using half an R, half an ADR, 0.5 ADR, 5%, we start trading at 10%. So when we get to 2R, then we start to trail. So that would make sense. So if the trade starts to work, then we start to protect it. We'll try that. That should be okay. Partial close, we've already done. So the main target. So it could be that we should be trying to get out, but we're going to get out on a trailer, aren't we? If it works. So we don't really need to set that lower. Okay, let's just try that. I'm going to run it on control points again. on optimization. We'll try that. And we'll see how often we get those coming in on those tighter ranges. We should get more trades coming in theory. We're not, because we're blowing the account very quick, look. So we've got 5 months there. So we've got 20, 40, 60, 80, 100. There's 100 trading days, potentially, roughly. So we want to be trading at least half of those days, ideally. So anything above 50 trades really is what we're looking for. Bear in mind, we can trade in both directions as well. So the top potential trades you'll get is roughly 200. Maybe the 1 to 3 R is too high. Yeah, could be. But I mean, anything below a 2 to 1 risk reward ratio, you're going to struggle. So again, there's not really producing any profit. There's a lot more kind of blown accounts, if you like, here. Again, this is kind of what I found in my testing. The whole purpose of the new version of the ORB strategy is to use range to determine volume, because we can't use centralized volume. So the only thing you've got is how big was the candle. If the candle was big, it means we've got volume, because usually you get large moves on high volume. So by using a 0.05 or a 5% of ADR as your range, you're saying, if there's no volume, take me into a trade. What's normally going to happen if there's no volume? It's just going to go up and down all the time. What's going up and down all the time in a range break strategy give you? Stop out after stop out after stop out after stop out, which is why you want wider ranges. Wider ranges give you less opportunity, but they give you more room for the trade to breathe and confirmed volume, which is what you want in a breakout strategy. So this variation I wouldn't expect to be particularly good, because we're trying to trade a much smaller range. There's only 48 variations running here. We'll quickly let this run. Nothing really making, I mean, we've got some making profit, but again, that's your break-even line there. So everything above that line is profitable. Everything below it is negative. Yeah, you got way more negative results than you've got positives. So again, not very good. Just because it's getting stopped out way too much. So the main things that are affecting this are 0.15. There you go. So this is the upper range. So 15% of ADR is what it's saying will make you a profit. Anything below that is not going to make you a profit. And again, this all goes back to the testing I've done on the normal OLB strategy. A 15 to 20% ADR range after the open is where the money is. Anything lower than that, you're going to get whipsawed too often. So you've got to keep that range high. And this is what this is backing up, basically. It's saying the same thing. If you want a decent profit factor, you need to be using a range of 0.15 or 0.1 as a very bare minimum. All the tiny little ones, not working. Stop loss at 0.1 of ADR, so keeping your stop tight is more profitable. Again, we know that. You're going to get stopped out more often, but the risk reward is easier to achieve when it breaks, because don't forget, with a breakout strategy, it's either going to break or it's not going to break. If it's not going to break, get out early. If it is going to break, milk it. Yeah. So your strike rate's going to be 30%, 40%. But when it goes, that's when you're going to make your money, and you will get stopped out a lot on the strategy. So this is all, the pre-market is kind of backing up exactly the same as the normal post-market range breaks that we take. So there's no advantage there either. What we can try as well is looking at, on a 15-minute chart at 10 o'clock, we will look at those 3 breaks before. So the 1 bar, the 2 bar, and the 3 bar range, and try and take a wider break. So try this on the 15-minute time frame using exactly the same settings, but there's no point in using 0.05 on a pre-market. Or is there? Because it's not going to give us the point. Maybe there is. Hang I'm going to run that up to 0.2. ADR 0.1 going up in half increments. That's fine. Using a stop loss. Yeah. Multiples 0.1 going up in 0.5 to 0.25. So if we're going to use a slightly wider, let's just leave it as that. Right. So let's just try this on the 15-minute time frame and see what we get. So this is going to look further back in time now. So instead of looking back at bar 1, 2, and 3 being 5, 10, and 15, we're looking at 15-minute, 30-minute, and 45 minutes. We're taking a wider pre-market range into account. So let's see if there is an advantage in going with more basically time of price action, which gives us more of a range, hopefully, which means we should hopefully get bigger ranges, which will allow us to take the breaks better. Again, not looking great, is it? Look. So again, we're getting no trades on. Very few trades coming on. We got an option for 200 trades, i.e. one in each direction over 100 days. We're getting 12 trades, 29, 30s. Not many trades going in. The days we are getting, or the tests where we are getting lots of trades, we are getting better results. That's because these accounts, I think, are just getting stopped out way too soon. Maybe there's too much risk on. 1% is not a lot, though, is it, really? With a strategy like this. But yeah, no, it's just not working there at all, is it? Rubbish. So the 15-minute range, again, this is all irrelevant data. Don't forget, when the market opens, everything before the market is irrelevant because it is not proper order volume coming through, which is why we trade post-market. We see what the market is doing today, and when we decide what to do with that data. What's happened before the market is irrelevant. If it's been driving up like that because there's somebody wanting to place a load of buy orders before the market opens, it's got nothing to do with what the entire bulk of the trading community wants to do when the market actually opens. This is just a small opinion beforehand. This is the masses. This is what we're interested in. So again, absolutely no advantage in pre-market there at all. Let me just try. I'm going to see if we can just trade the 1 bar range. So I'm just going to look at that previous 15 minutes only, not look at the others. I just want to see if that gives different results. If that doesn't work, we will move on to the next test. This is not dissimilar to what I found when I was testing the original ORB strategy pre-market. So the pre-market set files I had were a lot more difficult to achieve results in without curve fitting. So I got some amazing results on pre-market, as you can always do. I can find the results pre-market on a piece of data that will give us an amazing equity curve. You can do that with anything. If you know what's happened, you just match the strategy to exactly what happened in the past and you make money. That's it. This is what 90% of the EAs out there are. They're crap. They're just curve fit to whatever data they've been tested on. This is what robustness testing is about, is making sure that you're not curve fitting the strategy, because if you are, it's not going to work in the future. So with the pre-market on the previous version, I found it very difficult to achieve very consistent results robustness-wise without the equity curve being very low. So this is kind of backing up what I found there. Okay, so this 15-minute is a much better test. So although we've still got a lot of results that are non-profitable, we've got some results now that are returning very high or better return on drawdown ratios. So we've got $900 of drawdown making $775 of profit, using a 15% of ADR pre-market range. So that 15-minute candle before the market opens has to be a minimum of 15% of ADR, i.e. we've got some interest before market open. Your stop loss is 10%, which is going to be roughly 2/3 of the range. So if we're here when we open and we break to the upside, we've got 2/3 of that initial range is where our stop loss is placed. Not trailing the stop loss and closing part of it out at 2.5 R. Okay, so you've got a higher than 2 R return. So again, standard trading, logic, if you like. If you target more than you risk, if it happens more than X% of the time, you are going to create an edge. That's just standard trading mechanism. So that works. So what it's saying is make sure you've got some volume at the open so that you're not going to get whipsawed or pre-market. Make sure your stop loss is within the initial range and target over 2R and you'll make money. So in this particular case, if you targeted 10, 20, 15 or 25, any of them basically, you make money. So let's just verify that on tick. Let me just load. I'll just load that one up. Minute. We'll do that on tick. So we can see what's going on. Okay, so there's your 1 bar range there. Too small, no trade taken, because it would have whipsawed to the upside, whipsawed to the downside, and you'd have stopped out on both trades. So that's good. 5-minute ORB today is what you wanted to take, which is the standard after the open trade. Beautiful. Yeah, and this is why it's better to trade post-market, which is my findings. So that didn't work. That one obviously way too small. There's just no volume. There's just nothing you can trade pre-market. That one kicked off at 1 o'clock news event. So we always had some news coming out that day. 1 o'clock is CPI often. So it's US news, kick that off. Market went sideways until the news, exactly the same as we had yesterday. Again, no trade. So we only got 29 trades, I think it was. Yeah, so 27 trades. So it's not going to trade very often because you're just not going to get that pre-market range. Again, that one there, 250, minimum needed was 317. That one would have worked if we'd have used 10%. So in that particular case, it would have worked on a 10%. But obviously, we've looked at the results, and the edge using a 10% range isn't there. It creates a long-term loss. And this is only 5 months of testing as well, don't forget. This is a short period. So double stop out there. Again, pre-market range. Yeah, if you'd have taken the 5-minute ORB, which was there, long, you'd have gone and broken out, pulled back, continued, and that would have been a profitable trade. Yeah, so 5-minute ORB, 10-minute ORB, 15-minute ORB, much more effective than pre-market again. Okay, so we've got one break long there. That one hit target. So we are up. And then we stopped out on the second part because we've got no trailer. Again, those results said using a trailing stop is not as effective as not using a trailing stop is more effective than using a trailing stop. In that particular instance, a trailing stop would have reduced that loss, wouldn't it? But that isn't the case most of the time. And this is I've said this in here many times before, but my findings on pretty much every strategy I do is that trailing stops actually make less money. But, this is why I trade manually. I make a decision on that day by day. But overall, trailing stops stop you out, which means that if it is going to go further, you ain't getting it. But they do protect your loss. So having a wide trailing stop, I find better because it allows the trade to work for longer. So there's a nice one. So that one's the first one I've seen actually there that we broke cleanly straight to target 2.5R and then went straight to 1 ADR target. Yeah. How many days of that like that have we seen? Don't get them that often, do you? So there you go. That's probably the best setting that we found on that 15-minute range. So one thing we can try now is we know that works. So using a minimum, was it 15%? 15% of ADR with a 10% stop. Okay, so let's test this. So 15% of ADR with a stop loss at 10% and not using a trailer. Now, I'll leave it as it is. And then we were looking at a 0.25 target, weren't we? So that's roughly, it's not actually 1.15 or something in it. It's not 1.5R. Right, so I'm going to try that. So at 10 o'clock on the 15-minute time frame, we're going to trade the 15-minute ORB pre-market. If that doesn't work out, I want to trade the 15-minute ORB. So I'm not going to be able to do that, am I? Hang on. So that's going to trade 30, isn't it? We can't do this with this version of the EA, can we? What I was going to do was trade the 15-minute pre-market and then the 15-minute post-market, but I can't do that. I could trade the 30-minute post-market, which includes the 15, but because the 15 most of the time doesn't trigger, it's going to be the 15 that it's going to take after the market, which is probably going to work. So let me try this. This might well just work out. Let me do a visual test of this first, just to see if it works. So what I'm looking to do here is at the open. Oh, slow down. At the open, we're going to trade that 15-minute pre-market range. Yeah, so that is your pre-market. There's the open. And then we're going to trade at quarter past here. We're going to trade the full range of that 5-minute open and the pre-market. Yeah. So at 10 o'clock open, we're going to look at that and go, have we got 15% of ADR? No? Fine. Wait for the market to open for 15 minutes, and then we're going to take a 15-minute ORB on whatever the ranges of the previous two candles. I think most of the time, because only 27 trades triggered on that candle, we are going to find that it's automatically just going to take a 15-minute ORB for us. Okay. So what it's doing is saying, let's try a 15 pre-market 15. If that doesn't work, we'll just take the normal 15-minute ORB. And that is a lot of the time when you look at the ORB strategy, that is what triggers. You get a lot less trades triggering on the 5-minute ORB than you do on the 15. Sorry, I just realized I've got a load of profits in here. Waffling away, not paying attention. This is what it feels like having an edge, plays out long term. Just let it play out. Doesn't matter, does it? If you don't touch it, it's just going to work. We'll just quickly look at these where they are. Yeah, I'm just going to pull that down just to make sure I get a partial on it. And DAX, going to pull that up. So I'm looking basically for us to retest those highs. So if we're going to close up here somewhere, I'll take a partial before we retest that in case that's the turning point today. However, if we're going to put in a lower high, there's an argument for taking a partial now. I'll leave it. Same with the DAX. So that's your kind of pre-market low, which is not real. But this is the pre-market low kind of yesterday. That's really yesterday's low. So that's obviously where we sat around all day yesterday. So that's where I'm looking to get out on the partial to the downside. Right, I'll come back to that in a bit. On terminal. So yeah, so that's what this test is going to do. So it's saying try me on a pre-market if you can find one, because I know there's an edge there. It's not very good, but there is one. If that doesn't work out, let's try the 15-minute ORB, which is the most common ORB that works. So let me just run that into another day. So there we go. So the 5-minute ORB way too small. Oh, sorry, 15-minute pre-market too small. 15-minute post-market, short failure, going to break long straight into the highs, which might be a problem, but didn't. Yeah, there we go. So TP1, no trailer. made a profit, but there you go. Straight break again. So pre-market, no use. 15-minute ORB worked. Lovely. Again, then you took a loss. Now, for me, this is where the trailing stop mechanism helps. That profit today should have been way bigger, shouldn't it? So again, we can test different TP levels. So what I'm going to do is, now I've verified that works, I'm just going to run a test on that. And we are going to test different TP levels as well. So profit, ADR. So for the TP2, I'm going to go with at least a quarter of an ADR. And we'll go up in 10% increments up to we're going with 0.25, 0.5, go 0.75. So this is going to be quite a lot more tests. So the partial close is running from 10% to 25% of ADR. Stop loss is running from 10 to 15% of ADR. Our initial range is running from 5. Not good. We don't want the 5. I know we don't want 5. I'll go with 0.1 and 5 up to 0.2, which means that's fine. Fine. Okay. So we'll run that test. Again, going to initially do it on control points. There's going to be quite a lot of tests in this one. And we're testing trailing stop, yes or no. We'll run that as an optimization and see how that works. See how many tests we've got. 1,280. Hang on, this is set into genetic rather. Don't want it in genetic. Or do I? Actually, no. For the purposes of today, I will put that in genetic. I don't normally, because I'm going to also run it on a 10K account just to give it a little bit more breathing room. I don't normally run genetic because what that does is it alters the results, the way that it tests the results. So what it does is when it finds something that's profitable, it will automatically latch onto that and try different permutations using the profitable settings, rather than logically running through test to 10, 15, 20, 25, 30, 35. It will go 10, 20. 20 seems to work, so I'll try 20 with all the other settings, and it prioritizes that first, which gives you a different order of results, and it will also give you less results. It will only test a maximum of 1,200 permutations. But I'll leave it on for the minute because it will give us a better idea probably quicker. So that's going to be roughly a 20-minute test, but I might not run all of that. We'll see how it goes. Yeah, some nice results coming in already on that. Positive R as well. So we've got a positive return on drawdown here immediately. So again, this is because we're trading post-market, not pre-market. So again, this is kind of just backing up what my initial testing was. So that one, you got $1,600 drawdown and a $3,000 profit. So we've got a positive R. Yep. So there's a 2-to-1 risk reward ratio there as well, with only 10% of drawdown. So some good results already showing in this. Max profit on it, $6,500. So that's a 65% return on investment for a 40% drawdown. So still positive is 1.5 return on drawdown. So for me, as a high risk strategy, which this is, that's a good return. So we'll test that in a sec. We just quickly look at what's let's pull it off the highs. We're putting in a lower high. This is 71.9 retracement on yesterday. So I'm going to take a partial on the DAX. I'm going to leave the FTSE as it is for the minute. Back to the testing. Right. So we got 245 results in so far. Very nice profit factors there, 1.43. So very high return on drawdowns coming in now. We got an $8.5 profit coming off of 44 drawdown. So again, that's nearly 100% return, 85% return for a 44% drawdown. Don't forget, this is using loss recovery as well. If you remove loss recovery, you'll get a better understanding of the actual strategy equity curve. But for this purposes, I'm going to be using loss recovery in the real world. So, yeah, I'll leave it as it is. So this is interesting. So we've got 10% of ADR as a viable. A lot of these are 10% of ADR, these high return on drawdowns, meaning that actually 10% of ADR on a lot of these actually is a good minimum range to use. Stop losses, this is the interesting part. Stop losses are all set at 0.15, which means that with the majority of these tests from there down to there, there's a couple of outliers in there with 0.2s in them and there. But everything else in that range there pretty much is 0.1, which means that we're using 10% of the average daily range, but our stop loss is 15%. Yeah. Now, that doesn't mean that we are taking trades at exactly 10%. That's the minimum range we need to. So those ranges that are put in could be 15, 17, 19, 20, 25, whatever. But the stop loss is 15. So what that does is it gives you the danger of actually triggering hedges, which is, as we know, with the stock index hedge strategy is not an issue. But with this one, we're going to be using stop outs. So obviously people in America can't do this, but using a tighter range with a wider stop works. TP wise, getting out with a partial close at 10 to 20% of ADR is the way forward. So what it's saying is you want to get out on a scalp. So the first trade is going to be a 1R to a 2R, roughly somewhere in that range. The second exit is going to range from half an ADR or 0.3 to 0.5 ADR. So all of these results are profitable. Yeah. But what we're doing here is we're moving our test from did the pre-market work? Yes, roughly, but very few versions of it, over to let's see if the 15-minute ORB works. We know that does because that's why the EA has been built, because the 15 and ORB has an edge. I know it's got an edge, and this is just the 15 playing out. So out of all of these tests, obviously, these are all profitable. This is where you start making a loss there. So that's all the results. Everything below there is a loss. So that's the edge. And this is a robustness test, obviously showing you that every single one of these permutations would have worked in the past. So there we go. 288 results run. Out of those 288, we've got 1, 2, 3, 4, 5, 10, 15, about 20 that didn't work. So pretty much 95% of the strategy system parameter permutation tests come out profitable. So what's this telling me? Don't trade the pre-market. There's very few rare variations pre-market that work. So again, with the ORB, I found it very difficult to get a pre-market range that was successful, just because the ranges were very variable. But the 15-minute ORB is an incredibly good strategy. So that set file, I'm just going to quickly save that set file. ORB V3, DAX 15, M15, one pre, one post. parameter permutation. Okay, so that's that test that I wanted to run. The second test I wanted to run was Tom Hugard's strategy. So somebody wanted me to test this. So basically what this strategy is, I can't remember which one it is. You'll probably know, some of you. He's got the school run strategy and the advanced school run strategy. But there's a strategy, and I don't know which one it is, that does not take that. So let's say that's the open. That's your first 15-minute candle. That's your second 15-minute candle. It uses this second 15-minute candle. So at 10:30, it's looking at the previous one bar on the 15-minute time frame. Yeah. So that is that strategy. So I'm going to test that. So at 10:30, what we're going to do is we're going to look at the 10:15 to 10:30 price action. So we're going to ignore the open, the first 15 minutes, and we're going to see what happened from the second 15 minutes to the half-hour mark, which is when the time price opportunity candle closes. Yeah, TPO. So I'm going to use exactly the same settings for the test, but I'm going to shift that time frame over and see how we go. So I'm going to test from 10 to 20% minimum ranges, using stop losses of 10 to 25%, take profits from 25 to 75%, whether we should or shouldn't use a trading stop, and a partial close at either 10 to 25% and 75% of the trade. So we'll run a test on that and see how we get on there. I'll run it on control points. We'll just see what we get coming out of that. Peter, let's say we have two different ORB strategies positively tested. Would it be a good idea to trade them both? Yeah. They're variations on a strategy. So what we're doing is we're saying, if I did the same thing every day, would it work long term? Yes, then do it. If I did something different every day, does it work long term? Yes, then do it. Your outcome will be the combined results of both of those. Yeah. The difficulty is, if you use a single EA to do that, is it may be in a trade automatically, and then it won't trigger the second version of the strategy because it's already in the first version of the strategy. So ideally, you want a strategy that you can run on one single EA, or run two separate accounts with two separate strategies. But yeah, if an edge is an edge. So it's different every time, isn't it? It's different every day that you trade, but an edge is an edge. If there is a long-term edge in taking a break of either the 5, 10 or 15-minute ranges, depending on how much the market moves, and using a 3R risk-reward ratio, that edge is the edge. Trade it. If there is an advantage in letting it move 3/4 of an ADR and then shorting it, do that as well. But if you've made 1,500 quid on the first edge, do you want to risk that 1,500 quid on the second edge playing out? The answer should be yes, because you know there's an edge in it. But when you see that edge destroy this morning's edge, it becomes counterproductive. It becomes psychologically difficult for you to manage because you're seeing yourself making profit and then you're going, oh, I wish I hadn't have done that. What you should be looking at is the long-term edge and saying, right, well, I know there's an edge on both of them. Just let them play out. So you can do that. You can run two accounts, or you could run two versions of the EA using different magic numbers. So with the ORB, so DAX, partial close taken on the DAX. And now it's gone just because I moved... Because I moved the partial up, obviously what it did was close out my partial and then decide to drop. Always the way. So yeah, if you want to trade two DAXs, use two different magic numbers. So use magic number 1, 2, 3 on one of them, and then use magic number 4, 5, 6 on the other. So one of them can trade the pre-market, one of them can trade the post-market, one of them can trade the first 15 minutes, the other one can trade the second 15 minutes. Up to you. EAs work on magic numbers. I haven't tested different... I mean, it's just not something I've ever wanted to do or needed to do. I haven't actually tested it live, but it should work in that way. Second 15-minute bar is the school run, is it? Is that what he calls the school run? Fourth 5-minute bar is advanced school run. I can't test that because I don't have an input for the fourth. Oh, no, yes, do, yeah. So the fourth 5-minute bar is advanced school run. Okay, so we can test that as well. I don't know. So there's 288 tests gone in there. This is using genetic. So we might actually get better results from this when we run a full test. So the difference between genetic, you can't see it. It's down behind my head here. Let me move it up so you can see. Still can't see it. Hang on, let me... There we go. So down here, you probably can't see, but it says 288/1280 and then brackets 288. Okay, so when you run a genetic test, a genetic algorithm, it takes the best genetic result and it uses genetic mutation, if you like, of that result. So although there's 1,280 system parameter permutation tests here, it only runs a maximum of a percentage of them based on the best result that it finds. So if you want to run the full test on this and get more than 288 results, you need to take that off. So in your testing, take that off and it will run all 1,280 permutations. That's the way I never use this. But for speed, to get quick, is there an edge there results, that's not a bad thing to do because it will find you, basically all that does is it tries to find you all the best, but it will skip some. And if one of those that it skipped happens to be the best, you won't get the best. Yeah. So that's not a full belt and braces kind of test as I call it. But that's the best way to do it, is to have that turned off. So out of that test, we got some very nice results, very nice indeed. So we've got profit factors of 2 there. So we took $1,400 drawdown and made 3,208 profit. So this is on a 10K account, isn't it? We're running. Yeah. So in 5 months, we generated a 30% return, 10% a month, and we took a maximum of 15% or 14% drawdown. So that is using, this is Tom Hurgaard's, I don't know. So the second 15, so this is called the school run, yeah. So this is the school run strategy, if you like, as he calls it. So they're taking the second 15-minute candlestick at 10:30. That's the edge. So if you use a 20% of ADR minimum range, so all of these results you see all the way down to there, so all of those results are using 20% minimum range. Yeah. So again, going back to the testing that I did, I found that 20% of ADR is the best to take because it means we've got good movement, which means we've got participants in the market. And when we take those breaks, we get breathing room to allow those participants to pull back and run. Yeah. And that's basically it. If they're going to go big in that first 15 minutes, we're going to get the continuation move. That's the whole thing. We're using the pullback and the run of the initial movement. So this is measuring the initial range going in, which is the whipsaw, and then that second minute 15, we're taking that. So the advantage of this variation of the strategy is you've got that 15-minute range going in, and then this next 15 minutes, if it's an inside bar, brilliant, we'll take a break of the inside bar. Yeah. If it is a bull bar, if that is a false breakout, we take the short after the false breakout. If it's not a false breakout, we're going to take the pullback continuation on the market structure. Long, higher low, higher high, higher low. We're going to get the higher high in, aren't we? Yeah. So it's actually not a bad strategy, is it? Because waiting for that first 15 minutes to go in and ignoring it, you're using the second 15 minutes to decide whether or not they're going to false breakout and reverse, or they're going to break out and continue. So that's not a bad variation on the strategy to run. So, but it's saying that 20% of average daily range is what you need to make it work the most profitably. Stop loss is 10%. These are all 10%. These are all 15%. These are all 10%. These are 15, 10, 15. So all of these permutations, anything from a 10 to a 15% stop loss, absolutely no problem. TPs, so the absolute maximum TP, 45 to 75, 45 to 75. So you're better off using a TP which is somewhere around about half an ADR to 3/4 of an ADR. However, if you use 1/4% ADR, they are still profitable. Just you're going to get not as good a return on drawdown. So again, same thing. We're looking to take decent risk reward ratios out of it. Trailing stop. So trailing stop on is those 4 results there. There's one there. There's a few down here. But overall, it's a mixed bag, I would say. But there's more results up in the higher range that say don't use a trailing stop. Partial close. Anything from 10, 20, 15, 20, 15, 20, 10, 25, 20, 15, 10, absolute mixed bag. So your partial close, anything from 10%, which is half an R, to 25%, which is 1/4 of a, which is in this case going to be roughly 1 R. So what it's saying is scalp. And this is pretty true of what Tom does, isn't it? So when you watch Tom scalp, what he does is he is in and he gets out very, very quick. He's a fast scalper. He's in on a candle and he's out literally within the next candle. So this is kind of backing up his methodology, if you like, which is get in and get out quick. Take whatever money is presented to you or don't, or get stopped out, basically. So, you know, that kind of backs up what he says, but leave a runner. So that works. Yeah, that's a pretty good strategy. So all of these profitable results down to here. So there's a lot less profitable results. So his variation of the strategy isn't as profitable as, it's not as profitable as mine, but it's not as profitable as what I've tested and come up with. But it's still got an edge, isn't it? So roughly half the results are profitable. Roughly half the results are failures. The ones that are failures, the thing that they all have in common is the target is very high, 0.75, 0.65s. So having high targets and using trailing stops is less profitable than using small targets, get out fast and don't trail it. So let it breathe, get out when it presents some money to you. Done for the day. Yeah. So that's basically that one. So I'll save that as a set as well. Again, these can all have further testing done. So this is obviously only the DAX and it's only a few months. So M15. So this one's called the school run. School run. So what was the other one you said about? 4th 5-minute bar. So we're going to run on the 5-minute time frame. And at 10:20, we are going to take the 4th 5-minute bar. So at 10:25, right? So let me just get this right. So that's the open. Oh, I need a 5-minute chart. Right, so that's the open. So that's the first 5-minute bar, second, third, 4th 5-minute bar. So you take a break of that bar. So at 8.20, you take a trade. This all seems a bit. So at 8.20, which is there, you take a break of that bar. So on bar at 8.20, when the 8.20 candle opens, I'm taking a 1 bar trade, yeah. And he is adding, yeah. So yeah. But so I don't know why I'm looking over there. I'm looking over here to make sure he's not listening, making sure Tom's not listening through Telegram, because this is where Telegram is. People don't want to put this in the wrong way, because I love Tom, what he does. I think he's an absolutely brilliant trader. He's got a great book. Love it. But people slag off martingale and they slag off lot multiplication. A lot of people don't like what I do because I use lot multiplication. If you think about what Tom does a lot of the time, yeah, and what you taught in all classes and all courses, never chase losses, right? What Tom does is he takes a trade. If that trade stops out, yeah, he will flip the switch and go the other way because he believes that that initial direction was wrong, and then he will take a short. If that works out, he adds to it straight away. What is he doing there? Doubling his risk. What is martingale? Doubling your risk, yeah? And then he will push it further and take more risk if it starts to work. And then he will get out here with a win. So he turns a losing trade into a winning trade by increasing exponentially lot size, lot multiplication, yeah? Exactly what my ORBEA does and my version of the strategy does. So he's using, if you look at what he does, and this is just what someone has pointed, someone did a spreadsheet of this for me to show me what a con man he was. And I basically had an argument with the guy because I said, he's not a con man, he's just a really good trader. You just think he's conning you because you can't copy his trades, which is what most people struggle with. You can't copy a scalper. It's too fast. So, but if you think about what he does, what he's doing is when he loses, he increases the size, but he takes a first trade and he doesn't increase or add until the trade starts to work. So it's a logical martingale type strategy, isn't it? Yeah. So it is kind of a gambling strategy that he uses, but he's got very, very good skills at reading price action, which is why it works for him. For me, it's far too stressful doing that type of trading. I would rather just increase lot size slowly and wait for the longer term edge to play out than get in super aggressive. But that's how you make very big money, by doing that sort of trading. But if you think about it, taking one trade, stopping out and taking another trade and adding to it when it starts to work is just doubling your risk, which is martingale. When you take your first trade, you're in. You're taking a second trade by adding. You're averaging into the position rather than DCAing onto a scale in like we do with position trading. He's averaging into winners, which is the best thing to do. But what it does is it moves your entry price closer to the current price, which means that if your martingale approach fails, you now have a 3R loss out of 2 trades, not a 2R loss out of 2 trades. And God forbid you'd added 3 or 4 into it, and that stops you out on all 3 or 4 of those. You're suddenly up at 5 to 6R loss. Now what do? The next trade, you've got to scale in super fast. If that doesn't work out because the market's chopping all day, what do you end up with? Huge loss. So just bear that in mind about the adding strategy. It is the right thing to do. In scalping, however, it is incredibly dangerous. In swing trading, it's brilliant. So you get into a trade, it works out in your favor, it pulls back, and then you add, averaging into it. But you're buying yourself a decent distance that you can protect that trade. When you're adding straight away, when something starts to work, intra-candle, that can be incredibly dangerous. Also incredibly profitable, yeah? I mean, if you can ride them, and that's where your psychology comes in, isn't it? Then that's brilliant, but difficult. You learned from David Paul, yeah. David Paul was telling a story. He was in a casino and adding when he was winning, and then he came up with adding to winning trades. David Paul didn't come up with it. It's been around in gambling for 200 years. It's just called martingale. There's lots of different betting strategies like that. There's martingale, there's Paroli, there's all sorts of there's the 135 approach. There's lots of these types of things which you can apply. If you think about it, what we're doing is gambling. Yeah, trading is gambling. You are gambling on black and red. Yeah, this is absolutely no different to a casino. You are a professional gambler. Yeah, whatever you want to call it, you are risking on red or black. When you press the button to go short, you are saying black. If it comes out red, you're losing. The difference between casino and trading is casino is binary. It is red or black. Within trading, it is also binary, but we have fractions of binary that we can use to our advantage by adjusting risk parameters. In a casino, when you go red and black, you put down $5. When the table is started to spin in casino, in roulette, for example, you can't go, actually, I fancy $7.50. That's it. When the wheel is spinning and you can see that it looks like it's going to come out as a red, you can suddenly go, okay, I'm going to reduce my risk and increase my reward. Or you can say, I'm going to double my risk by adding a new position. That's the difference between trading and gambling. But at the end of the day, all of the mechanisms you can use in gambling, which there are many successful mechanisms. Blackjack, for example, has got lots of great martingale type strategies and Paroli strategies. You can use those in trading, but you have to be able to adjust and manage the risk parameters around it. And that is where the system parameter permutation comes in. Because system parameter permutation testing is giving you all of the mechanisms for adjusting risk on the fly. Yeah. So it's saying, dependent on the size of this, the size of this, the size of this, should I use a trailing stop or not? Yes. You've added another mechanism in. And what size should the trailing stop be? Any of them. They all work, but these are the best ones. But when should I start trailing? Any of them, but these are the best ones. So combining all of them together gives you the best possible outcome. But that's the best possible outcome on the data that you have tested on. If you take that and test it on another piece of data and it still gives you the best results, you know that's the strategy to use. It's all the same stuff. No, we are basically doing pretty much the same thing. Okay, so that strategy. So I am entering at 1020. Hang on. 1, 2, 3, 4. So I'm entering on the 1025 at 1025 or 1020. 1020, aren't I? I'm entering at 1020 and taking a 1 bar range. Let me just run a visual. Wrong time frame. 5 minutes. Let's test this one as well. Might as well while we're here. If you're bored and you want to go, come back and watch the rest of it later. 8:20, right, okay. So open is there. So that's your first 5 minute candle, your second 5 minute candle, your third 5 minute candle, your fourth 5 minute candle. So that is your advanced school run short. Yeah? Cool, that worked really nicely that day, didn't it? Straight down. Lovely. Okay, so that's your 1 bar range. So this is the advanced one. It seems very random to me. Doesn't it seem random? What is the logic behind using this random fourth candle? I haven't read up on Tom's stuff really. I don't, I'm aware of everything he does, but I don't really follow it. Is there a mathematical, or is it, I don't know how he's come up with this fourth bar. It just seems like he's gone, well, we'll pick the fourth one. It's Tom H logic. All right, okay, there you go. It's unique, but then again, everything that's different works, isn't it? This is, Okay, so there we go. So that one's fine. Range on that was 206. So we need to test, first of all, size of range. So, I mean, I don't think you're going to get that many trades on with it, but we'll try a 0.5 upwards to a 0.2. Our stop losses, I'm just going to use the same settings. We'll just test the same thing again. I think we'll do it on control points to start with. Again, this would all need to be back tested properly on tick. Control points is a very rough method, but it gives you a rough idea of whether it's worth actually following something. It's not going to give you the right results, but we'll test this. So it's 384 tests. This is going to be a 19-minute test. So let me just get some initial results out and see what it makes of them. But yeah, I'm very logical and mathematical in everything that I do. When someone says to me, take this random thing here, it makes me think, why? What is the advantage of taking the fourth candle? It's not a time frame. There's no time frame that is there? You've got the first 3 candles is 15 minutes. The second 3 candles is 30 minutes. And then you've got 2 15-minute ranges in there, and you've got 6 5-minute ranges in there. The fourth 5-minute candle isn't the 15-minute range. It's just the fourth 5-minute candle in the middle of nowhere between time frames we cannot view. Just doesn't, I don't know, it just doesn't make any sense, does it? You're just taking a random kind of trade in the middle of a 15-minute range sort of thing. I don't know. I'm assuming he's tested it because obviously it exists. So I presume he's done testing. But it's just a system parameter permutation test at the end of the day, isn't it? So this is all negative so far. That's your positives. Maybe I should have tried this on genetic. I might quickly run this on genetic just to get some quicker results that are positive. The problem with this, I think, he's skipping between strategies. One day he takes the SR, another ASRS, then he takes high-low, etc. Doesn't take the same setups every day. No, but that's because he's got lots of setups, isn't he? That's no different to me. This is discretionary trading, so I made totally the wrong decisions today. This is what trading is all about, right? What I should have done today is taken a partial on the FTSE and left the DAX. What I did was take a partial on the DAX and left the FTSE. The FTSE is now going to stop out in a loss. The DAX is going without me. Yeah. What was the right thing to do today? Exactly what I just said. If I'd have known what the right thing to do, I would have done it. What Tom, I guess, does, which is what most good traders do, is they use their discretion and they look at what they're seeing on their chart. So if you take a trade and you see the school run strategy or whatever strategy set up there and it triggers, you take it. If it makes a profit, you're done. Why would you take the next version strategy if you've made your profit? Today, I've taken these trades and I've banked 237. And obviously this is going down and that's going down with more loss on it. So I'm going to come out with a profit. What I could do is say, I'm going to take a double bottom bounce. But why would I want to jeopardize this profit to try and take another? That's over trading. So there's nothing wrong with taking different strategies, different strategy entries, because what you're doing is you're playing out the edge. If the edge on the first one works, leave it. But if you want to play the edge on the second one, go for it. But you may want to adjust your risk so that you don't lose all of your profit on the first trade. Discretion. Again, there's no right or wrong way of doing it. This EA works for me, based on the logic that I use, which is if a trade doesn't work out, I will slightly increase the next risk to try and recoup the losses faster and reduce that risk reward ratio needed to get back to break even. Tom will add more size to his second trade if he's had a loss. Or if he sees something and he's really confident in its first trade, he might add to it again, but he'll move his stop faster. So he's adjusting what he does based on what he sees. So if some days he takes one, some days he takes another, some days he takes something different, great. If, and this is where the problem comes in, if he's showing his results based on what would have worked that day, it's like me just curve fitting the EA and saying every day I will run the EA every day on 15 different accounts with different settings on. And what I'll do is I'll screenshot the one that works and I'll post it up on Telegram and go, look how amazing this is. There's 14 variations that didn't work, but I'm only going to show you the one that does. That's a problem. Yeah, and that's what 90% of these signal services are doing. They're getting people in by showing them all the working trades, but they're not showing them any of the crap. And then you suddenly sign up for money and you go, hang on a minute, what's all this rubbish? That was an utterly wrong decision today, wasn't it? So stopped out flipping short on FTSE. And obviously DAX is through the floor. So somebody said something, I assume. Trump. Nagel, June's rate decision to depend on incoming data. Is very supportive of debt break. German economy ministry. Backdrop to US tariffs. No, doesn't look like there's anything impacted. It's just market movement. It's a shame. Should have let that run. Never mind. So I'm still guaranteed a profit for the day. Obviously, I'll be back for the afternoon session. It's coming down really hard now. Look. So again, right, I was sitting up at $800 in profit here and here. I could have just closed the lot out. But the reason I let it go today is because I had a $1,000 day yesterday. So I thought, let's push it. See if we can get a little bit more. Wrong decision. What I should have done is bank the 800 today. But now this is dropping down. So if this gets down into those lows and the P&L net comes up to sort of 500, 400, I will shut everything out manually and take that 500 because I've had an $800 win turn into an $80 loss, which turns into a $400 to $500 profit. I'm taking the 400 to 500 because the market today is tricky. Doesn't make me good or bad. And this is where I get the stick as well, as most people do that show their trades, is people will go, yeah, but you didn't tell us you shut it there. Mine stopped out. I can't help you with that. It's what you'll learn over time, that you need to take money when money's presented. Yeah. I don't think there's a problem with what he does, Tom. But, you know, it's... This is for people to backtest. You know, this is why you do all of this work. You backtest yourself. Don't trust anything anybody says. Don't trust anything I say. Yeah. Do your due diligence. If you get different results to me, look at why you're getting different results to me. If you get the same results as me, brilliant. You've just backed up what I say. Yeah, but you've got to do it yourself, haven't you? Not getting great results from this, look. Not bad, but there are your profitable outcomes there. And these are the non-profitable. So this is the advanced school run strategy, the ASRS. Not very advanced, is it? So this is taking the random 5-minute candle in between the two 15-minute candles. I'm guessing maybe the logic he's thinking is, if we put 15-minute candle in, we're going to take a pullback entry or a reversal entry after the 15 minutes has gone. I guess, maybe. Don't really know the logic. But so return on drawdown is 1. Not great. That's negative return on drawdown. That's negative return on drawdown. That is the only positive return on drawdown. This one, 668 off of a 387 drawdown. with a 20% of range, 10% ADR stop loss, TP at 35% of ADR, no trailer, again, no trailer's best. Part closing at 0.2. So you're using a 2R initial part close with a 3.5R max TP. So again, in, out, fast, scalp. It's a scalping strategy, isn't it? Whereas my variation of the strategy is more of a breakout hold strategy. I'm looking for them to break and go for the day. Tom's looking for them to push and get out quick. That's a totally different approach with high risk. Yeah, if you're going to be a scalper, you need to be scalping with $500, $1,000 in, out, and you need to get that one trade in and that's it. You're done for the day. Whereas my approach is much more, let's let the market go where the market's going and take the money after a period of hours rather than minutes. Totally different approach. My ORB. That doesn't look very good to me. I can't really get any decent return on drawdown out of that, apart from one. Everything else it's all negative. Look. Oh, test is over. There you go. It's done. Do the testing yourself, though. You know, go and set it up and play with it. But I mean, those two set files that I've just tested, they look pretty good, don't they? So this is all done on the DAX. I'll put these in the members group. You can have a play with them. Oh, I did a Trump face then. I felt myself doing a Trump face then. I went, he does, isn't it? Okay, they're in the so go and have a play with those and just do some system parameter permutation testing on them. Have a look at the variations, see what you think. But for me, the idea of today was obviously to test pre-market, and I don't think the pre-market range is right for this variant of the EA, and the pre-market, as I said, I've done before, I found it very difficult to make money long term. There is an edge there in it, and you can produce an edge, but the edge is going to be frustrating to trade because you are going to get stopped out a lot because that pre-market range is nonsensical price action. The open is where we see price action and we see clues to direction. We see clues to volume for the day. So that's where the edge is that we've got some kind of movement to play with there. The 15-minute ORB, as we've just shown, very, very effective, which we've always known. The 15-minute ORB is kind of the bog standard version of the strategy, which is why a lot of people trade it. So, holy crap. Okay. It's melting, isn't it? I don't know. Market's just not having much fun today, is it? Right. So I'm going to do something here which is just going to guarantee a profit for the day. So I'm pushing my partial close line up here. If we bounce from here, wherever we close, whether it be here or whether it be there, I'm taking half off, 3/4 off. This one is already locked in with a trailer, so guaranteed to make profit on that. So my minimum profit that I can make today is 136 on that trade. So that 136 profit on the DAX there pays for that loss. And whatever I get out of this, obviously, is going to be profit as well. So it's going to be a profitable morning. It's just been like pulling teeth trying to get it, and unfortunately, failed breakout short. So, and that was my personal error. If I'd have let the EA play out, we'd have had a partial down there, not down there, and have made a lot of money. But This is the discretionary part of trading, isn't it? This is what happens. You're never going to get it 100% right all the time. Okay, that's where I'm going to leave it today. So I've covered everything I wanted to do today, which is ORB. I will rename this stream so that we know what the stream is about today, because I just called it members session. So I'll rename that in a bit so that you can find it if you need it. I haven't got any other plans for ORB development at the moment, apart from the new variation on the strategy that I'm testing at the minute, which is the reverse ORB, which is basically looking at percentage gain and loss statistics and looking at ways to take percentage extreme mean reversions intraday. So that EA I've built, I covered it in a previous stream in a little bit of detail, but it's this one here. Not that, that's wrong one. It is, oh my God, what have I called it? Percentage range trader, I think I called it. Yeah. Oh no, I don't want to do an SPP on it. So what this is doing, and this is my next major project, is gathering data on extremes. So all of these lines are average percentages up, average percentages down, maximum percentages up, and maximum percentages down within specific ADRs. So this line here is basically the maximum we've gone up in the last 10 days, which is 0.96% of price. This one here is the maximum we've gone down in the last 10 days, which again happens to be 0.96. That is the average down in the last 60 days, which is a long-term average directional bias. And it's all about getting these lines as close as you can together and shorting when you get there. On average, this is where it goes to every day. So if we sell it when it gets there and just leave it for the day, if that is the average up we get, we hope we close lower. Yeah. So it's playing the statistical edge on average movement over time. And obviously this EA gathers all that data into a spreadsheet as well, so that it allows me to analyze it in spreadsheet form. I've got it taking trades at the moment at random as well. Not at random, it's taking trades based on stuff. But I don't know whether, I just needed it to do some trades basically so I could get some data in there. Why is one of my lights just gone out? Both went out. Yeah, so there you go. So that moved down by the average. It took a long, then it moved up by the average and took a short. Obviously, probably wouldn't do both of those. But they both worked out. That short made profit and that long made profit, because that's on average what it goes down by and that's on average what it goes up by. And it did exactly what it does on average, went up and down by that distance. So, you know, that's the sort of that's the sort of thing that it does. And obviously it also grabs data. So again, when I've got this working in better form, I'll put it out there so we can sort of do some testing on it. But what it does basically is just spit out lovely data. We love data. Data makes money. So it shows us all the information about, you know, starting price for the day, whether you went long, whether you went short, how high did it get? Did it trigger the average 10-day, 30-day, 60-day? What was the price after that? What did it come down by as a percentage? Where did it get out? Where was the maximum drawdown? Gives you all the data you want, what the day's range was, how far it went up, how far it came down. So it's basically looking at statistically what happens and then using this as an edge. So if it goes up by 1.3% and then comes down by 466 on a regular basis, you know that you want to sell it after it's gone up by 1%. And your maximum you'll ever get out of it is 4.66. So let's go for roughly half of what it moves down on average. So what we can do is we can look at what is the average maximum down we get, 1.51. So on average, it moves down by 1.51%. So if on average it moves up by X and you sell it up there, what's the maximum down you'll get on average? That. So let's just go for 1% down. So when it goes up, you target 1% drop. Yeah, and that's how you can formulate an edge, because statistically in the past, that's the facts. You know, all good strategies are based on fact. When something does X, do Y. Repeat. Yeah, so if without the facts, without the data, you can't formulate the strategy. So this is what the data gathering stage is all about. And this is what the CA is designed to do. But obviously I've built trade functionality into it so that I can system parameter permutation test the facts when I know what facts we've got to use. So, but this is basically to complement ORB on a short-term basis. So all the ORB strategy is doing is going on those breaks. We're going to move up. When we move up, what do I need to do to get back down again? Yeah. So this is the inverse of ORB. So it complements the ORB. We've got a breakout strategy running alongside a mean reversion strategy. So it doesn't matter whether the market goes into breakout or it goes into mean reversion. One of those strategies should succeed in theory. If it breaks out to the average and then mean reverts, happy days. We make twice as much money. Yeah. So those days will be your paydays. So it's just about putting the statistical movement of price in a formula that works. Yeah. So, you know, things like there's a lovely trade I just saw there that made real good sense. There you go. Look. So statistically, that was the average down over, I would say, probably 10 days in that case. We took a long, yeah, and then it went up statistically, whatever, where it should short it, but that didn't work out. But that is just being taken off of that. So, you know, taking 2 trades in a day is a hedge mechanism. Obviously, those days you're going to sort of reduce your winnings, but also you've got the chance of making twice as much money, haven't you, as well, if they both play out. So you're getting a hedge from the bottom and a hedge from the top. So it's just looking at all of those statistics to see what is the best thing to do, and have something that you really do not have to rely on as being, I need a signal for this, I need a condition for that, I need this, that, and there's the simplest strategies are the ones that work. So if something goes up by X, sell it, because X number of times it comes down. So you risk X, you risk Y, you target Y, done. Yeah, so it's just keeping it simple and making those data-driven decisions with strategy. So, but that's my next, that's what I'm working on at the moment, as well as a load of other things, which I always am. And somebody also contacted me the other day, who's not a member, about currency strength. I have been through this, so I might do another session on this. I don't know if when I did it, but it's quite an important one, currency strength, because no, I haven't done a member stream on it. So I might schedule a member stream in maybe for next week on this. Currency strength is something that people get really fixated by, because they believe, and the wording that he was using when he was talking to me, I was like, you're mad. But he was like, you know, this has gone up by this and this has gone down by this. Therefore, the market has to do what? The market doesn't have to do anything. The market does what the market is told to by the buying and selling pressures. It doesn't have to do anything. But people get into this fixation with currency strength meters. And currency strength indicators, which literally tell you what has happened in the past. Again, price action tells you the same thing. So it's another way of viewing candlesticks in effect. But I might do a session on it because it's quite an important thing to understand currency strength and the relationship between distance of movement and currency strength. But I had quite a long conversation with the guy because they wanted me to build an EA to trade it. And I basically poo-pooed it because I've spent years doing it and it doesn't work. There's no advantage to it. But it looks great. It's one of those bells and whistles strategies that looks, oh, look at all the wiggly lines that are telling me exactly what's going on in the market. Hey, do you know what I've got? These candlesticks that tell me exactly what's doing the same thing. So I might do a session on that because it is quite important. I think a lot of people don't really understand what currency strength meters tell you. He looks like it was a chat 1-to-1 today. I know, Peter, I think you're the only one here. I can't tell numbers because it doesn't give me numbers. But yeah, you and me today, 2:21. Not bad. 2 hours, 21 minutes of one-on-one mentorship for 35 quid a month. I don't think you can go wrong with that, can you? Right, I'll let you go, Peter. Is anybody else still here? This would be a good test, wouldn't it? Is there anybody there? I'm watching the chat. I think it is just you. Either that or I've got a really bad delay. Chris is still here. I didn't see any other combos. All right, okay. Right, out of the FTSE partial. God, this is a horrible pullback. I'm just going to protect this with the break even. This is. You know what? I'm taking this all off. I'm just closing it all. Done. 336. It's going to want to pull back on that, and I'm pretty sure. So I'm just going to take all this off and be done today. It's a very tricky. Although we've got this massive movement, I've just got the movements wrong today. So I'm just leave the morning on a profit. Listening and learning, cool. Also like form me only. Form me only? Right, I'll be back next week, obviously, for member stream. Maybe we'll do that one on currency strength. If there's anything else you want to do, I will also be developing that EA, so we'll do some more on data analysis for the indices. Just to leave you on what's going on with the FX side of things today, nothing, you haven't moved. So nothing happening at all. Swiss yen's in profit. Aussie US pushing up a bit. Very, very. Euro's rallying. Pound is rallying. Looks like dollar's dropping. Got weak dollar today. The market's hacked off with the dollar again. Wow, really hacked off with the dollar. Just about to get an ADR, US dollar yen. Oh, just pulled back as I went like that. ADR just about to hit US dollar yen. Yeah, very weak dollar. Again, market not liking those CPI figures by the looks of things. So continuations on those shorts, which is not the end of the world because I've got the one exposure, single exposures at the minute. Risk tight. Right. Have a good day. I will be back this afternoon at 2:30 for the US session. Anything you need, let me know in Discord or Telegram. And yeah, I will see you soon. Have a good one.